So I said I was going to give you examples. So now let's take a look at Apogee Enterprises. This is a stock that we own. And by way of background, Apogee has two segments. They have high-efficiency glass and window systems that they put in high-rise buildings like this hotel and downtown, all the glass here in Houston. They're a part of that. They also do the non-reflective glass for art, for pictures, so it's in museums and such. It's a smaller part of their business, about $100 million in sales, but very profitable. But the bulk of their business is the high-efficiency glass. They're the market leader in each of their industries, where they are expanding internationally. They've got high barriers to entry. It's a difficult process. You can't just buy a coder and set it up and think you're in business. It's also not something easy to ship from China on a boat. It takes 3 months to get here, and it's hard to get just in time on a construction site. I can't imagine a contractor would be too happy when it's late. So it's a very regional business. From a balance sheet perspective, it's got a very strong balance sheet, about $1 in net cash on the balance sheet. But it's a late-stage cycle business, which means at the bottom of the cycle, it generally loses money or doesn't make much money. And at the top of the cycle, it's making a lot of money. And in between, it's growing its earnings appropriately in between. But what that means is in the beginning of the cycle, there's no money. It doesn't report much in terms of earnings. However, it generates free cash flow throughout the entire cycle. So now, instead of going through an HMA on Apogee, because you'd never see it, I converted the relevant information in HMA from a valuation standpoint into a series of charts. So this next series of charts is how we look at Apogee from a valuation standpoint. So on this chart, I've isolated the tangible book value per share for Apogee Enterprises, which is one of the 14 metrics that we use to value businesses. As I said, with companies like Apogee, it's a cyclical business, so it doesn't show much earnings at the bottom of the cycle. So earnings-based valuation metrics can often become meaningless. For example, if you have a $10 stock and it's earning 10 cents, that would imply 100 PE on the stock, which is very expensive from a PE standpoint, and which is why you often see when companies are cyclical and they're losing money, analysts often, especially that solely use earnings-based models, immediately put sells on it or don't cover it or drop coverage because they don't have any other way to analyze it, which is why we use a multi-valuation approach to it. And in this case, in cyclical companies, we look at tangible book. That's our favorite aspect to look at. And now, those that may not be familiar with tangible book, if you take all the assets of a company, subtract all the liabilities, you end up having net worth or tangible or book value. Then from that, if you take goodwill, patents, copyrights, and subtract that off, you have tangible net worth. So now if we look at the chart, you can see that while there's been ups and downs along the way, the tangible net worth of Apogee Enterprises has grown rather steadily over time. Now it's cyclical, so there is some ups and downs, but over 20 years of all the economic ups and downs, it's grown pretty nicely over time. Now let's look at the stock price. Kind of volatile. Gone from $5 to $25, back to $5, up to $10, down to $5, back up to $30, back down to $8. So again, value investors say, I see opportunity in this. The academic says, it's too risky, I don't want it. Now the buy low, sell high is our kind of stock. So this is a great opportunity for us. But we have to have a methodology in how we can compare the price to the value. So now let's look at this next slide, where we do compare price and value. So these are on the price and the tangible book value. That's the last two slides combined here. That's what this is. And they're both on the same scale. And what you'll notice is every time the price hits tangible book, it's the bottom. And it doesn't last that long either. This also coincides with the time that the stock is the cheapest and where the reward to risk is the greatest. Unfortunately, it's also the time where most people are fearful of volatility and seek low volatility, exiting out of stocks like this or not even looking at stocks like this, and in the process give up great opportunities. So now let's look at the next chart. We saw how it bottoms at tangible book, but now we need to convert this into a ratio of price to tangible book. This way we can see what the price to tangible book ratio is at any time over the last 20 years. So the numbers going up the side, the 1 represents that the price is equal to tangible book. 2, 3, and 4 means the price is 2 times tangible book, 3 times tangible book, and you can see it peaks at 4 times tangible book. And so now if we look at where our value zone is for this stock, anytime it gets near 1 times tangible book, it's cheap. Anytime it gets to 3 to 4 times tangible book, it's expensive. And now, as I said, when we wrap everything up, we put it into our valuation structure. For us, the worst case on the stock is 90% of tangible book, which would equate to $8. Our buy point is 1.15 tangible book, so that's $10, and the sell point is 3 times tangible book, or 26. If bought at 10, we have an 8-to-1 reward to risk ratio. Do you see how volatility can play in your favor when you have a process that can value a business and captures that value gap? That's what we do. That's the difference. And it's not just looking at what hurdle rate is. We want to know how wide that gap gets. At 2 times tangible book, you could double your money from 2 to 4, but it could also go down to 1. And that's what we try to capture when we look at stocks and understand how wide that gap gets during economic downturns. So this is a great example of the value gap and how our process captures that, and that captures the opportunities that volatility creates.